Brad Thomas adjusting the camera, my friend. Don't make yourself look taller than you already are than me. I'm the mini and the skinny. You're the tall guy. Let me brag on you for a second so everyone knows who the heck you are. Let's start with, you've written a book about Trump before it was popular to write books about Trump. You are probably the most prolific writer that's ever lived on Seeking Alpha. You probably have the most followers, the most articles, and I'll as a former contributor, I'll say high quality articles too, right? You don't just write junk and clickbait. You've been a successful investor in real estate. You've been a failed investor too. I value the fact that you're humble about some of your career stumbles, and then you're a father of 5 or 6. I can't remember.
Yeah, 5 kids.
Five kids.
They're young adults now, Lou. So I don't like to call them kids anymore. They're all working and employed, so they're not kids anymore.
Listen, man, the accolades go on and on. I'm glad to have you on the show, and really want to pick your brain if you let us do that on real estate.
Yeah, no, it's great to see you again. And look, I love I love the intro, by the way. Just I fully agree, and I'd love to talk about American real estate today. I mean, obviously, my wheelhouse, my circle of competence is commercial real estate, and of course, you know me. I've been in this business for a long time, and was a developer before I became a Wall Street writer, and now at my new company, Wide Moat Research, is where you're going to find me now. I do, Lou, still write on Seeking Alpha occasionally, and I love going into chats and these types of forums and social media like this. So. Well, absolutely.
Listen, hopefully,
thank you again.
Yeah. Hey, listen, let me ask you, this week we're going to get existing home sales and new home sales. What do you, when that data is coming out, like, what are you looking at? Does that bother you as a long-term REIT investor? Are you keying into that for potential opportunities in residential focused REITs, or do you just focus on something different altogether?
Yeah, so absolutely. I mean, we cover builders, but in terms of like real estate, and REITs, real estate investment trusts, we've been looking at the single family rental market. We think that's a really attractive market, both single family rentals, Lou, as well as manufactured housing and even apartment complexes. Obviously, there's that trade-off of the housing market slowing down, and the elevated rates has really created an opportunity for the single family rental market. So we think there's a lot more demand, in rentals. But also we're watching these numbers closely. I mean, I think there's some really interesting opportunities for home builders today. But I think the more attractive sector right now to play in is in the rental side of the game. I'm actually looking at buying some private rentals myself, just believing there's opportunity in that in that marketplace.
That's an interesting thread. I mean, you cover the home builders, right? If you look at the home builder ETF, the XHB, I mean, it's had a good run over the last 5 years, which might confuse people because, right, you haven't had new home sales, existing home sales have kind of been petering out a little bit or flatlining, but I think the builders are doing a good job of controlling inventory and their pace. But what are you talking about? So single family rentals, are you doing that actually through individual purchases, or is there a publicly traded vehicle that allows people to do that very cost effectively?
Yeah, there's a couple different public REITs that just primarily came about as a result of the Great Recession. So there's 3 of them now. American Homes for Rent's kind of one of the largest out there. But back to the builders, I mean, I think the really opportunity I see is buying some of these houses from builders. A lot of builders are actually partnering now with some of the REITs to unload some of that inventory and get it into the rental market. So I think there's really a good opportunity there, but again, I think we definitely have seen some challenging time for builders. But I do think, Lou, you were right. You were spot on earlier when you talked about just consumers and, are out there spending. I mean, I still think the economy in the U.S. is relatively strong. So, I guess, I would not ignore builders. I think there's certainly going to be some opportunities going forward. Companies like Toll Brothers, which is kind of a luxury space. We like them a lot. But yeah, I fully agree with you. I think there's some opportunity there. But on the rental side, we really like that, especially, Lou. I'm here in South Carolina where I'm based, and
Wait, you're not in upstate New York, man? That's not an upstate New York accent?
No. I am not. And look, I think I'm part of that migration, but I think we're seeing a lot of opportunity throughout the Sunbelt, and so that's really where we're really focused on right now in the rental side.
No, and look, I think it makes sense too, because the latest data I've seen too surprised me, right? Because after the financial crisis, the housing crash, you saw a ton of investors flood into the single home market. but it really didn't push right now. The current percentage of single homes owned by investors is about 15, 16%. Not up dramatically from back then, I mean, where it was 10, 11%. So it's not saturated with investors, I think, which the mainstream media likes to portray that, oh, Wall Street owns all of real estate, and that's why there's a housing shortage. But when you look at this, what's the big fundamentals for you? Is it the fact that we're, 2.5 to 3 million homes short of household formation in terms of supply? Is that the real long-term driver for you in these investments?
Well, I think, really at the end of the day, I mean, we're really focused on these job numbers. I mean, I think that's really fundamental here as to whether we're going to be going into a recession or not. And right now, I think the market is relatively strong, and that's really good outlook as well for the builders. So, like you were just discussing earlier, I mean, I think we're on the same page here. I mean, earnings really drive prices, and earnings drive dividends, and dividends drive prices. So we really like to see, at least from the real estate, from the REIT angle, those companies that are able to continuously grow their earnings and dividends. And so, but yeah, housing is certainly a good indicator. But again, the consumers are pretty strong right now. We're seeing that in the retail sector as well, Lou. I mean, the shopping center and even the mall sector is doing extremely well. So, that's a pretty good indicator.
That's interesting. So I haven't looked at the REIT performance in the retail sector. What have they been doing lately? Because I think people would be, you see Walmart saying they're going to announce price hikes to cope with tariffs. We saw a couple quarters ago Target suffering from demand decrease. What's really going on in the REIT sector and retail?
Well, first of all, separate malls from shopping centers. But what's interesting, I just did some research over the weekend. The malls were the top performing property sector in the REIT space in both 2021. Malls were up 92%. Now that's the COVID bounce, right? Coming back right out of COVID, but malls were up 92%. Of course, we were long and recommended Tanger Outlets, which is in that category, and that was a great pick for us. But what's also interesting, in 2024, the malls were the top performing sector. So malls are still alive. We obviously.
It's amazing. Like, I would not think that they're still alive, right? I mean, and I have two teenagers, but I can't remember the last time I've been to malls and saw them thriving. But remember the real estate crash the last time we were told malls were going to be gone, right? They're done. It's lights out.
Yeah.
Game over.
Well, we certainly saw that dislocation in COVID, and of course, we wrote about malls before COVID and predicted there was an extremely overbuilt sector. There was maybe 1,400 malls, I think we researched before COVID, and a lot of those companies filed bankruptcy. Fortunately, we didn't recommend any of those companies like Washington Prime or Pennsylvania REIT or CBL, but just sticking with the best-in-class companies like Simon, and they've done extremely well coming out of COVID. But I really like, Lou, the grocery-anchored shopping center model. I was a shopping center developer myself before I became a Wall Street writer. And, this whole necessity-based value proposition for shopping center REITs, companies like Regency, who has Publix as one of their top tenants, or companies like Kimco.
Man, I could use a pub sub right about now. 5:30 on a Monday, man. The little Buffalo chicken pub sub. If you don't know, you better find out. They're good, man. And you're in South Carolina, so you get them. So you like the retail sector, you like the grocery anchored. Where can people get your top recommendations? Before we let you go today, I want to make sure that everyone knows where to find you. It's at Wide Moat Research. That's where they can find
WideMoatResearch.com.
WideMoatResearch.com.
We have a Wide Moat Daily, a free daily called Wide Moat Daily. Absolutely.
Listen, I encourage everyone to pick up a copy of Brad's book, go to his website, check out his information. He knows the ins and outs of REITs and real estate investing like I do in the biotech and tech world. I would not go anywhere else for my information and investment insights there without talking to you, my friend. I hope you enjoyed your inaugural appearance on The Big Skinny. I would love to have you back again when you got some time.
Anytime. Thanks again, Lou.
All right, brother. Have a great day.